Good morning, and thank you for joining us today for the NCBA Investment Bank webinar. Um, we will be discussing interpreting stock market and research reports today. My name is Samuel Gishohi. I am in the Business Development Department of the NCBA Investment Bank Brokerage Division. And welcome, and thank you so much for joining us. This is our third in a series that we hope will continue to assist you and to empower you as our clients in being able to understand investment in the Nairobi Securities Exchange and in the various different types of instruments that we handle here at NCBA Investment Bank. I would like to really thank those who joined us last week. Last week we were discussing our online trading platform, and the week before we had a discussion on how to navigate this COVID-19 period in terms of investment. And we are very grateful for the great turnout and the great responses that we got. We had a lot of questions, and we thank you, and we say keep them coming. We are really, really excited to empower you and to keep you informed on what is going on. Today we'll be talking about interpreting stock market and research reports. And I'm going to begin by quickly taking you through the stock market reports. And then after I go take you through that, which will take about 10 minutes, I'm going to hand you over to our research analyst, Dennis Kariuki. Dennis Kariuki is part of the team, the research team, that spends their time looking through the statistics that I'm going to show you, collecting statistics from different industries, different companies, doing company visits and meetings with the different management of companies in order to bring you research reports that help you to make decisions as you go through your investment journey. So I'm going to begin by showing you some reports that you will usually receive from the Nairobi Securities Exchange. These reports are available on the Nairobi Securities Exchange, and they're public reports which give you just the daily, the weekly statistics, and maybe a summary of what the market has been doing. I'm going to start by showing you what happens on the daily equities price list. Now, this price list, which is available on the Nairobi Securities Exchange website, www.nsc.co.ke, is to show you what has happened in a snapshot at the end of a day. So this is a static report, and therefore it shows you what has happened and is not live. It does not happen during the live market. For those of you who joined us last week to deal with the online share trading platform, you will notice that we already know some of the terms that are being used here, and you do see this same information, probably slightly different, but you do see this information on the Market Watch, which is on the online trading platform. So to see the prices or the things that as they're happening live on the market, then you use the online platform that we showcased last week. But when you want to look at a snapshot or a summary of what happened on the market, then you look at the price list, this price list. Now the daily price list on the far left shows you a 52-week high and low. This is to show you over the last 52 weeks, which is roughly a year, actually is a year, what has happened or how much has that price moved, so that you can be able to tell vis-a-vis where the price is on the date we are looking at. So for example, on this 22nd of this month, you're going to see that the Williamson T Kenya share price was 178 shillings high during the 52 weeks. During those 52 weeks, the lowest it hit was 92 shillings. Then you have the name of the company there, and then you have a code. That is a code that is used on the market. So that is not that is a code for that company, which is referring to Williamson T Kenya. And then you have that trading status. There's a row there that says trading status. Now the trading status shows you if that company has any corporate action, and I will explain corporate actions as I go along, which is associated to that company. For example, is it trading X dividend? Is it trading CAM dividend? Is that counter suspended? On that row, you're going to be able to figure out if that company is in a certain status or has issued any corporate action. Then the next row, you have the bid and the ask price. The bid is where the average demand for that day was, which is 122 shillings on Williamson Tea, Kenya. And the ask price, which is the supply, ask stands for supply, is means that the investors who are selling were asking for 132 shillings on average for that day. On the same day, we had a high of 121 shillings on that same counter. And if you move on a little to the right, you're going to see that the lowest it traded on that particular day was also 121, which means that that share price did not change during the day. And that informs us that the next one informs us the volume weighted average price. The volume weighted average price takes the volume of shares traded and uses it as the weight to see, and then takes the prices, the different prices that it traded at during the day, and they do a calculation to come up with what we call the volume weighted average price for that day, which will then be what translates to the opening price tomorrow on the day after. So if you're looking to know what the share price, opening share price will be on the closing share price, sorry, the closing share price will be on your online platform for tomorrow, then it would be showing you on this volume weighted average price. And it also shows you that the previous price was 121, so we can see this counter was quite stagnant during that period. The last row shows you the volume of shares traded, and that volume of shares traded was 600 shares on 22nd of June 2020. At the bottom of this this price list, on the right-hand side of the price list, we have some statistics which give us the general market statistics of that day. Now, those statistics include: one, market capitalization, the total number of shares that are listed on the market, multiplied by their prices gives you the total market capitalization. And here we can see, for example, that on the previous, which was on Friday, the market capitalization was 2.2 trillion, whereas on the next day, which was on 22nd, you can see that it was 2.1. So you can see that change means that generally the market went down during that one-day period. The number of shares traded, this is the total number of shares traded on a particular day. We can see that the volumes on the 22nd were much lower than the volumes on the previous trading day. And you can see that from 41 million shares traded, it went down to 9 million shares traded, which indicates that the Monday was a slow day. Equity turnover is the total number of shares value that has been traded. So it's the total number of shares multiplied by their price, which gives us our equity turnover. And for that day, the turnover was on, and this is on both the selling and the buying. The previous one was 936 million, and we can see that on Monday again it went down to 202. Then below that we have the total deals. This is the number of transactions that happened. So we can see there is 1,185. So if you wanted to know the average transaction size, you can easily get that by dividing by doing some division there. We then have the investment rate. Indicates the real estate investment trust, which is reported separately from the rest of the market. And we can see the turnover on the real estate investment trust was 366 on the 22nd, and the previous trading day it had been at 950, also indicating a decline. And that can also be seen in the number of units or the total deals that were done, which went from 33 to 25 on the day we are dealing with. So these are just static and one-off statistics that you can quickly use to make short-term calculations. On the left hand of the price list, we have what we call corporate actions. Now, corporate actions are material announcements that have been made. Material meaning that they can have an effect on the share price of a company. And these corporate actions are periodic, and therefore, when they are announced, they will appear on this part of the price list. And these corporate actions will be giving you those different actions that a company has done. Has it announced a bonus? Has it announced a dividend? Has it announced maybe a rights issue, etc. And in every corporate action, there will be 3 material dates. So first of all, it will tell you which company. For example, there we can see Safaricom highlighted and NCBA Group highlighted. And those are the ones we are going to use just to explain. On a certain day, which they announced, and they will give you the date of when the announcement was made. And the first thing they will tell you is what the announcement was about. So here they announced a first and final dividend of 1 shilling and 40 cents on 29th April. So that is the first material date, the date of announcement. Then there is another material date that is the books closure date, of which is here it says 31st July 2020. And then they go on and tell you on the date on which the payment of that dividend will happen, which is the 1st November. Now, how this works is that on the date of announcement, the public is given information on what dividend is being paid. Then there's a date of books closure. It means that anybody who buys this share between 29th of April and 31st of between 29th of April and 31st of July, which is the books closure date, will be eligible to get the dividend. On 31st of July, when the books closed, anybody who has not bought the shares or who buys the shares after that will not be eligible for the dividend. So it means that once those books close, the next thing to look out for is the payment date, which is 1st November. And 1st November is the date when anybody who was in the books by 31st of July will be expecting to receive the money in their bank account. The same happens, for example, in a bonus issue, which you can see there for NCBA Group, which announced a bonus issue of 1 share for every 10 held on 22nd April 2020. And the books closure for this is on 12th May 2020. And the crediting date is subject to approval. It means that the board or the AGM has not yet come up with the date on which the actual payment will happen. However, this will be done. This crediting, for example, is going to happen on a date that will be announced at another date. The other report that may be of interest to you is what we call the weekly market report. The weekly market report is also a static report that gives you statistics of what happened during a particular week, and it will start by showing you a slight difference where you can see now we don't see the 52-week statistics, but now after we see the name and the code for that company and the par value, which Dennis will come and explain some of these terms, for example, like the par value. We'll now show you on a weekly basis what was the volume weighted average price last Friday and what was the volume weighted average price on the Friday when this report was released, which is June 19th of 2020. This report is released on every Friday, and so if you look on the NSE website, you will be able to see it. The price change by percentage for that week. So in this case, if you look at the first one there, you can see that the share price went from 9 shillings to 9.90. So the difference of that was a 10% change in the price. Then we see how many shares were traded during the whole week, and we can see that most of the shares we can see they are quite illiquid. But if you look below there, you can see ABSA had about 14 million shares traded, which is also indicative of the number of shares that were traded. Going back to the top, you then are given another statistic, which is the total number of shares that company has issued in the market. And if you multiply that by the share price, then you're going to get the market capitalization, which is the next tab. And then we have some statistics there. Now, these statistics are what has informed our discussion today. Reason being, we can see that the earnings per share, the dividend per share, the price to earnings ratio, and the dividend yield. Now, all these have a meaning when it comes to valuation and pricing of a share. And while they cannot be used individually to make investment decisions, there are certain ways that they can be deciphered or interpreted in order to give you information that can help you to be able to deal with to make investment decisions. And that is where Dennis comes in. Dennis and the research team at NCBA Investment Bank will take these statistics. They will do company visits and collect other data from the market and from different sources, and then they will now put all that information in what we call research reports, and he will tell us the different reports they do, how they actually create these reports, and their importance to your decision making. I would like to thank you for listening to me, and I would like now to hand you over to Dennis, who is our research analyst, to be able to take you through the research function at NCBA Investment Bank Brokerage.
Thank you, Sam, for that elaborate walkthrough on the NSC reports. Now, to our viewers, thank you for joining us this morning. We appreciate your time. So, as Sam highlighted, I'll be taking you through research reports. And to just recap on the journey that we are on, we have had 2 webinars now where we started with the question, should you invest during a pandemic like the one we are having? And the answer to that question was yes. Because we highlighted that value exists in the market, even in times of war. And there are always pockets of value whereby some stocks will be undervalued, others will have potential. So there's always that. Then we went on, and Samuel last week explained to us how we can be able to trade stocks on the online platform. And then what we are going to do today is give you a manual or a guidance on what to buy, what to sell, how to invest. And research is that aspect that gives you that information to be able to make the best decision. So to kickstart this presentation, I'm going to have highlighted the importance of research when investing. And when you look at the slide I'm having here, one of the importance of research is to be able to provide investors with timely information. And we need you to have the best information out there for you to be able to make the best decision. And this information could be regarding a company announcing its results. It could be a company expanding. It could be a company buying another, that is acquisition and mergers. It could be a company closing a factory if it's in manufacturing. So that information is interpreted or diffused into the price of the stock, and you need it on a timely manner to be able to make the best decision. Then we have research as a provider of data-driven investment advice. If you saw the NSC reports with a lot of data, and we're able to diffuse that data into some meaningful information that can be able to direct you on where to invest. So we interpret those data points to actual information that tells you a story about what a stock is doing or what a company is doing and its valuation as well. Then the other importance of research, as we highlighted at the beginning of our first webinar, is that value and price are 2 different things, and research comes in to draw the line between those 2 aspects. Remember, a stock could be trading at a price of 20 bob per share, but the value of the stock is 60 bob per share or 10 bob per share. So that brings in the aspect of undervalued, overvalued, or it could be trading at 20 bob per share and it is also valued at 20 bob per share, which we call a fairly valued share. So research is able to come in and tell you this share is overvalued, this share is undervalued, the price will go up, the price will go down, the price will not move. Then the other importance of research is to be able to take away the guesswork and make your work more efficient when investing. If you look at the online trading platform that we were showcasing last week, it had a lot of moving arrows, greens and reds. And when you're on that platform, you could just say, I'm going to pick the green. It shows it's going up. I'm going to pick, say, Safaricom. I'm going to pick Williamson Tea. But when you have research, you're informed. You're able to know, why am I going to pick Safaricom? Why am I going to pick Williamson Tea? Why am I going to sell Stanbic? And all those aspects. So we take away the guesswork, and you're able to go there and say, I know this stock is performing, this company is performing well. So the guesswork is off the table, and you can be able to invest in a good, informed way. So then, when we are investing, there are different types of asset classes. And today we are going to be focusing on the first asset class. As you can see, it's equities, and equities comprises of stocks or shares in a different term. We also have things like equity mutual funds, derivatives, and all that. Then we have fixed income, which looks at treasury bills and bonds, fixed deposit, corporate bonds. We may have a webinar to talk about that asset class in particular in the future. Then we go on to an asset class like real estate, which we saw a real estate investment trust that is listed on the Nairobi Securities Exchange, the Fahari iRight, which gives you an exposure into the real estate sector. And then we have alternatives or alternative asset classes, which include now private equity or commodities. Private equity is the opposite of equities, because equities or stocks are listed in a securities exchange, where private equity is a private owned company. So you cannot be able to buy the shares in the public market. Then we have things like hedge funds. So today we are going to focus on equities, and what we're going to do is discuss how we come up with a report on a company, because when we're analyzing a company, what we want to have as the end product is the price of that company's share. And 1 unit of share is a unit of ownership in that company. So that's a critical information. When you buy the stock of a company, you are buying a unit of ownership in a company. So we have to find the value of the company and find the value per share of that company. So as a research unit at the NCBA Investment Bank, we are able to provide you with a range of reports to be able to enhance your decision making. Remember, this is a manual to your investment. You need a manual for you to do something you are not familiar with, or even enhance your own skills if you're familiar with investing. So some of the reports that we're able to provide you with are macroeconomic reports. And these reports highlights how the economy is doing, our projections on key parameters such as GDP growth, the movement of interest rates, inflation movement, the impact of that on your investment. So that is depicted in that report. Then we have weekly reports on both equities and fixed income. So we're able to summarize what happened last week using that weekly statistics report from the NSC, and give our guidance on what we expect for the forthcoming week. We also have a fixed income report that analyzes treasury bills, treasury bonds, the economy, and gives an outlook for the week and the next week in terms of what we expect to see in that element. Then we have an annual markets outlook, like the one we had at the beginning of the year, giving you our opinion and views of how we expect the year to span out in different asset classes. So we cover equities, fixed income in that annual markets outlook, and we're able to provide you with an outlook on the other sectors as well. Then we have the core of today's research report discussion, which is a company report. What goes into the company report, and what are the elements that then are feeded into that report to be able to say, we want you to buy this share of this company because these and these and these. Then we have sector reports, which are looking at different sectors in the economy. You can have, for instance, a banking sector report, looking at the listed banks in the Nairobi Securities Exchange. Then we have company earnings updates. We are able to provide you with updates on earnings of companies as soon as companies release their results, because that information is critical. If the company did well in a certain quarter, in a certain half year, then the price is likely to reflect that improvement in profitability, and the price may go up. So that is important for you to have it in a timely manner. Then we have quarterly market updates. And this is to say, we have an annual markets outlook, but then at the beginning of the year, we did not know that coronavirus is gonna hit the markets as hard as it did. So what we did in our Q2 outlook is pricing the impact of coronavirus. And we're able to have a different outlook because we already see how the coronavirus is going to affect the market. So we have these quarterly market updates that are able to update what we had at the beginning of the year, taking into consideration the current market environment and movement in the financial services markets. So moving on. So now, as I highlighted, we are looking at company reports, and that is analyzing a company which the end product is the price of the share of that company. So what two methodologies are there to be able to come out with the pricing of the shares or stock of a company? And broadly used are two methodologies, as you can see on the slide. We have fundamental analysis and we have technical analysis. Fundamental analysis, as the term is fundamental, it's critical or the intrinsic. It looks at the core elements of the company. As you can see, the industry, we have to understand how the industry is doing. We have to understand how the economy is doing and the economic conditions impact on that company. We have to be able to project the future outlook of the company. We have to understand who is the CEO, how is the corporate governance of the company. That is fundamental analysis, getting to understand the intrinsic elements of that company. Then on the other hand, we have technical analysis, and these would mainly involve moving averages, charts, and indicators and oscillators. I know you have seen charts depicting prices, movements, and that is to say, if the price moving average, for instance, in the last 100 days has been at 75 and the price has gone down to 65, that is to say, there's a high likelihood that in the next trading or 3 trading sessions, the price could go up towards the moving average of where it was. So technical analysis, as the term highlights, it's technical. It's just looking at the price movements over time and coming up with a view of what you expect to see, given that the price movements that are there. Have people overbought the share, and what is likely to happen next? So it's using of charts and moving averages. A lot of graphics are used in these analysis. So moving on to what, in the fundamental analysis, what are the contents of a research report? And when we are doing analysis of a company, we are basically telling you the story of that company, because if we turn the analysis of the company into a story, it is easier for our investors to digest the information rather than just bringing the critical, difficult terms to explain what is happening. So we like to put it down as a story. And as you see, we start off and we use fundamental analysis for analyzing companies and for our recommendations on whether to invest or not to invest in a certain stock. So we start off with industry analysis. And when we are doing industry analysis, we are looking at how is the company positioned in the market? What is the market share of the company in the industry? If the market share is not growing over time, then we see these a big problem. Either the competition, as you see, the next element is the competition. Competition has increased in the element. There are many entrants into that industry. So we see, does the company have a chance to survive in that kind of environment? Then we look at how the economic environment is impacting certain industries. So the best way to look at it is comparing the economic growth and the industry growth. If the industry is growing below the economy, then that's a bad indicator that the industry is not as attractive. But if the industry is growing above the economy, that shows the industry is an economic driver, and it's a good sign of how the company is doing as well. So then we move on to understand the company itself. And two critical elements to understand about the company is the corporate governance and the business model. And the business model involves products and services and how they are delivered and all that logistics. So corporate governance speaks to the leadership of the company. That is from the board of directors and also the management. So because when you're looking at the company, you have to understand that the strategy that has been put forth by that company is going to be executed by those in leadership. So you have to understand, do the people in the board of directors, in the corporate leadership of this company have the skills or capability? What are their track records? So after understanding that, you're able to say this strategy may be executed or it may not be executed after all. Then you have to understand what products or services is the company dealing with, how do they deliver, and all that kind of logistics, because you have to understand the product as well. Is the uptick going down? Is the uptick going down? So then you go on and understand the investment case. The investment case is also the investment thesis. And the investment thesis there, you're trying to say, in this company that you are looking at here, what are the drivers or the catalysts for growth? So are there elements that are going to drive the growth of this company in the future? And they are 1, 2, 3. Then we have, what are the risks? Because everything has a swing between return and risk. So what is the risk of me going into this company? And we are able to highlight for you the risks we see in this company is maybe concentration of clients. If one client falls off, if, for instance, you're looking at a company where government is the key client and the government stops doing business with the company, then the company may be going down. So that could be a risk that we're able to highlight for you after understanding the business model of the company. Then the other element now towards the finalization is understanding how do we come up with the valuation. When we say the stock of Safaricom is worth 35 shillings, fairly valued, then we come up with a financial model. That's the first element. And the financial model is basically forecasting the financial statements of a company from the balance sheet, income statement, and the cash flow. And we get, for instance, the income statement where we look at revenue. What are the revenue drivers? If the business has different, what do you call them, business lines, the business lines that are going to drive growth. So for instance, you can look at a company like Safaricom and you have the business lines that include M-Pesa, data, you have voice, all that is used to understand how is the business going to deliver revenue growth. So you're looking at M-Pesa is driving growth, data is driving growth, maybe voice is not driving growth, and you're able to project into the next 5 years. We use a 5-year horizon for our projections. Then after getting to understand how the company is going to deliver the different aspects, which is revenue, expenses, and then you have the profitability, then you're able to see how much value does this company have using valuation methodologies such as discounted cash flows. And discounted cash flows, for instance, is taking, let's say you have a mango tree, and this mango tree gives you 1,000 mangoes every year, and you sell these mangoes for 30 shillings. So that means you have 30,000 every year from the mango tree. So if you wanted to sell that mango tree, maybe you'd look at the next 5 years and say, this mango tree can bring me 150,000. And then you discount that using, say, inflation, because 30,000 today is not the same as 30,000 next year. It will be worth less because of inflation. So you discount it back and say, maybe this mango tree, if I was to sell it, I would sell it for 100,000 today because of the value that I see in the next 5 or the horizon that you're looking at. So that's the same case for a company. You look at the cash flows that the company can generate over the next 5 years, and you discount that to the present value to be able to have a value for the company. Then after getting the value of the company, you divide that basically by the number of shares that the company has to get the value per share. The other methodology you can use is relative valuation. And relative valuation is pricing the shares of the company with the industry averages or peers in the market. If a peer is, and there you use multiples that I'll show you later, multiples, and saying if this company is priced at this, these companies could also be priced at these multiples. So it's usually using multiples, and I'll show you the multiples that you use mostly for this valuation. Then moving on, then after understanding all these about the company, the final product that we are looking at is to tell you, should you buy, should you hold, or should you sell the stock of the company? And what do those recommendations mean? Well, looking at this slide, we are looking at the ratings that we use in-house here at NCB Investment Bank, and we have a strong buy, a hold, and a sell. Now, I have green on strong buy and buy, which means go. Go means buy. And as you see, strong buy has a 12-month return. We usually give a target price for 12 months. We say the stock is trading at 20, but in the next 12 months, the price could go to 30. So if the stock can appreciate by more than 20%, also adding a dividend return to that, and it's more than 20%, then it's a strong buy, and we highly recommend that you buy it. Then we have a buy, a flat buy, whereby we are looking at a 12-month return or capital appreciation, which comes from the price moving from a certain point to a certain point, say from 20 bob to 30 bob. So if that appreciation is between 10% to 20%, then that's a stock that you should buy. And if I can go back to the strong buy, when we are saying a return more than 20%, remember equities are more risky as opposed to, say, fixed income instruments like a treasury bond. If you bought a treasury bond, it could be giving you a return of 12%, and that's a free rate return, a risk-free return. Then we have equities. So for you to be able to have a strong buy, you must be able to be compensated on the risk-free rate, which is 12%. Then you have a premium on that. So you have an equity premium of 8% for you to have a 20% return, which now says you're compensated enough for the risk that you're buying towards the company. Then we have a hold recommendation, which is just holding the stock, just stay with it. We see it having a return. It may increase the dividend, but we see it having a return of maybe below 10, but not a negative return in terms of capital appreciation and also a dividend return. So you hold the stock, it may pay off at the end of the 12-month period. Then we have a sell recommendation, and a sell recommendation would indicate it is time for you to offload the stock that you have. You do not need it. We see it going, we see the price going down in the next 12 months. It's time for you to sell. So those are the recommendation ratings that we have. And that is what they mean when you see someone saying sell, when someone says buy, when someone's saying it's a strong buy. So those are the different, meanings of those ratings. So moving on. We have now the valuation ratios. And the first valuation ratios, as you saw in the weekly equities report from the NSC, we have an earnings per share. And let's go to the mango tree that I was using earlier to show the value of the mango tree. If you have a mango tree and say, this mango tree is owned by 10 people, that means everybody owns a 10% of that tree. If we are harvesting 10,000 mangoes every year, that means every one of us is going away with 1,000 mangoes. Now that is earnings per share. Your earnings per your holding is 1,000 mangoes. So the same case comes to the company. The company generates a certain amount of profits. And the reason you're seeing here having net income less dividend on preference shares is because, as the term indicates, preference shares indicates that they are preferred over ordinary shares. What you would buy on most of the companies that are listed is ordinary shares in the Nairobi Securities Exchange. So you have to deduct the dividend that is paid on the preference shares because of the ranking that is there. So remember, I said that stocks have a higher risk because you have debt holders at the top, then you have equity holders at the bottom. Debt holders comes first. They are more preferred. They are paid first in case of a liquidation, but equity investors take the highest risk. So if the company goes bankrupt, they may not get anything at the end. So you have to be compensated for that risk. So moving back to the EPS. So earnings per share, you have the profitability of the company, and we have, say the profitability of the company is a certain number, say 2 million. And then we have the number of outstanding shares as 2 million. So the earnings per share will be 1 shilling, will be 1 shilling. That is what earnings per share mean. Then before I go to the price to earnings ratio, I would go to the dividend payout. So we have the 1 shilling as earning per share. So the earning per share, it's 1 bob. Then the company has a dividend policy that says we are going to pay out 50% of our earnings. So that means from the 1 shilling as the earnings per share, you're going to get 0.5 or 50 cents. That's the dividend that you're going to get. So the dividend payout is 50%, dividend per share over earnings per share. And then you can be able to put that towards the dividend yield. If your dividend yield is 0.5 and the price per share it's X, you can be able to see the return that you're getting from the stock from dividend return. So you're able to add that dividend return to the capital appreciation to see the total return that you'll be getting for holding the stock in a particular period. And that will inform whether it's a buy, a sell, or a hold. So then to some of the ratios that we use mostly to value companies relatively to each other in the industry is price to earnings ratio. So this takes the market price per share and divides it by the earnings per share. And what does that mean? Because a ratio is a relationship between two metrics in the market. So it indicates how much are you paying for every unit of earnings of the company. So sometimes the PE, it does not just tell you the story, because if the PE is 10, it may not be telling you anything. You have to compare it to the industry. So the higher the PE sometimes indicates that investors are willing to pay more for that company, but you have to compare it to the industry. But that is what it means. It means how much are you paying for every unit of earnings in that company. Then we have the book value per share. The book value is basically taking the net worth or the shareholders' value of the company and dividing by the number of shares. If you were to sell all the assets in that company and deduct the liabilities of the company, what would each of the shareholders get? That is the book value or book value per share. What would I get as a shareholder if we sold all the assets and paid off all the liabilities? And we use book value per share mostly for financial services company that have items that can be sold. Let's say for a bank, you have government bonds, we have loans as assets. So all those can be sold off and pay the liabilities, and then investors can be paid with the remainder. So from the book value per share, we have a price to book ratio. Now you may be able to see this sometimes on social media or on company reports. And price to book ratio basically says we are taking the market price and dividing it by the book value per share. So let's say the market price per share is 20 shillings and the book value per share is 20 shillings. That means the price to book is 1. And if you have a price to book of 1, it would, on a natural sense, indicate that the company is fairly valued. But if the price to book is below 1, let's say 0.8, the company could be undervalued. But then you cannot use the multiple on its own. You have to compare it to the industry. You have to compare it to peers, to historical levels to be able to come out with a recommendation. But on a natural, essential sense, it means if the company has a price to book below 1, it is undervalued. If the company has a price to book ratio of say 1.5, it is overvalued. But that has to be compared to the industry. So those are the key ratios that you may be able to see on company earnings reports, on newspapers, everywhere. So, and that is what they mean. All right, moving on steadily. So the other important aspect of research is to inform you on when to enter and when to exit. Because remember, as we say, during a pandemic, there's value that is to be tapped in the market. So the market may be down overall, but then there are stocks that has value in them. If you look at the top green, the green arrow that is looking at Safaricom, Equity Bank, and KCB, these stocks exhibit some entry points that are very attractive. If you look at, for instance, Equity Bank in June 2015, the price was 47.5 shillings. Then it went down towards 46.3 in June 2018. Then it went all the way to 53.5 as of December 2019. And now it is currently at 35.7 shillings. So if as a research unit here at NCB Investment Bank, we have valued Equity Bank and said the share of Equity Bank is worth 60 shillings. And the price as of December was 53, and it has gone down to 35.7. That means at that point of 35.7 is a lucrative buying position that will provide you with a very high return. As you look also at KCB, the same case has happened. The price has gone all the way from a high of 54 in December 2019 to currently 36.2 because of the impact of the coronavirus pandemic. So that also indicates if the company, if as a research unit, we have analyzed KCB Bank and we have come up with a valuation of 60 shillings at 36.2 shillings, then that says it's a buy and you should be entering the stock. Then we have the other red section, whereby we have KPLC, Nation Media, and Uchumi. And this section indicates a trend that is quite worrying. If you look at KPLC, it has come from a high of 18.4 in June 2015, all the way to a low of 1.9 in June 2020. And the same case applies with Nation. There is no point where you can enter and exit with a return. It's all going downhill in these stocks. And that's where research also comes in. If we have done research on a company, say Nation Media Group, we have come up with a recommendation that says, as of January 2019, we do not see this company having a reversal. It's coming from a price of 180 to 81. The market is not doing well. The segment that they are operating in, it's not doing well. We do not see any new initiative that the company is taking to deliver returns. We do not expect the company to do well in the next 5 years. So then we are able to recommend to you, this is a stock that you should be exiting right now. And some investors maybe are seeing this and they are realizing they should have exited at a certain point, but they do not have the information. So as a research house, we're able to come in and provide you with information that helps you to know this is the time to buy, this is the time to sell, this is time to sell all of it. So that is quite critical because we have the information and we spend our time trying to understand how these companies are doing and their future prospects. All right. Then we have, so there are different investment strategies that can be used because as we were beginning the webinar on Should You Invest, we highlighted something called risk analysis. Your risk appetite will also inform what kind of stocks you should be investing in. And if you look at this table, we are looking at 3 categories of stocks, and that is dividend stocks, value stocks, and growth stocks. Now, the difference is that dividend stocks will be able to offer you a very good dividend payout at the end of the year when they announce their results. And that can be a large stock and mostly a mature company. As you can see, the example we have there is BAT. BAT has been paying dividends throughout. They pay about 80% of their earnings as dividends to their investors. So if your risk level is quite low, these stocks tend to be fairly valued most of the times. So there's not much capital appreciation. So the price may be stagnant at 400 and not moving a lot, but you're able to get your dividend payout at the end of the day. So that is one category of stock to look at. Then we have value stocks. And value stocks indicate that your investment horizon has to be mid to long term because they have potential for growth, and they are usually mostly undervalued. So these are stocks that have a lot of value to be tapped, and they're usually undervalued, and they also pay handsome dividends most of the times. So the examples we have is KCB and equity. Then we have growth stocks. Now, growth stocks speaks to companies that have high potential for growth. Sometimes they may be overvalued, but they have high potential for growth. That to take capital appreciation may be there for you in the long term. So they may not be paying dividend most of the times, but the example I've given there is Safaricom, which exhibits most of the characteristics of a growth stock in our market. And as you can all see, Safaricom is a company that is expected to grow in the next foreseeable future of 5 years or 10 years. So that's the example I've given. So you can see the best investment strategy for you. You can combine the three strategies, say, I want dividend stocks, I want value stocks, I want growth stocks, because you need dividend return for yourself, you need capital appreciation. If you combine the two, then it becomes a better strategy for you. So then we have our stock picks. So after analyzing the companies and coming out with the valuation, we have some picks for you, which we believe are stocks that are well priced in the market and have good entry points and exit points for you. So you're able to get in and get out at a very good position with capital appreciation and a dividend return as well. As you can see, we have on one side Safaricom, we have ABSA, INM, Equity, and KCB in the banking sector. Remember, we are looking at also companies that are driving the economy. So one of the sectors that is growing exponentially is the telecommunication sector, which Safaricom plays a key role at. The other sector is banking sector, which is also growing very well. And the other company that we see value in is EABL. Strategically positioned as a regional player and a lot of innovation that is going in there. So that is the end product of coming out with all these research analysis, company analysis. We come to the end and say, these are the picks that for now, as at this point, these are the companies that we see holding value for investors. So maybe we can go to some Q&A. I can see some questions are trickling in. Maybe we can have a look at what people are asking about. Isaac Ndorito is asking, what does the recommendation dividend play imply? Dividend play implies that you have to get into the stock when it's about to pay its dividend. So before the date that Gishohi was talking about, that is the book closure. You buy the stock before the book closure so you can be able to get the dividend return. Also, it can imply you go in and buy a stock that is in the dividend stock category. That is what dividend play means. So Gishohi, you have a question on your end?
Just a moment, please. There is a question there from Bonakiruti. Bonakiruti is asking, does NCBA have a department that works like an investment bank and allows a customer to just have some funds in the account that the department plays with in the stock exchange? Yes, we do have, as part of NCBA Investment Bank, NCBA Investment Bank is we have 3 different departments. We have the brokerage, which is what me and Dennis have been taking you through. We have the wealth management, and the wealth management is where we have different unit trusts and different, even private wealth management, different wealth management packages, and these packages include our money market fund. Our money market fund is a fund, our unit trust, which invests in money markets, which includes treasury bills and bonds, etc. And then we have our equities fund. The equities fund invests in the stock market and diversifies within that area. And then we have a dollar fund, which of course is investment in the dollar. Now we expect in the next 2 weeks to have a session in which we are going to take you through our wealth management products and our wealth management and how you can use them really, which is the importance of these sessions, how you can use them as part of your investment portfolio. Thank you so much, Kiruti, and I hope that we shall be able to engage further and help you with this particular product. Back to you, Dennis.
Yes, I have a question here from Kimani. Kimani is asking, can someone change shares from ordinary to preferential ones? Now that depends on what the company is doing. This is what we call conversion of shares from ordinary to preferential. And that can happen when the company requires maybe a change of preference shares to ordinary shares for different purposes, but it's only, it's a company decision. So you cannot be able to change that on the exchange. So it's a company decision at the bottom line, but it can be done when the company requires it to be done.
Right, looking at another question here from, before the question, thank you so much, Pius Ngoge. Pius Ngoge is congratulating us. He says, empowering customers with information is key for business continuity and sustenance. Good job at CBA Bank. Thank you so much, Pius. We shall continue to engage and to ensure we give you as much as we can. So, Njero Chris, thank you also for your compliment. Great presentation, guys. A quick question. Can I trade futures via your platform? Our online share trading platform is for only deals with the listed companies. We hope and in the near future we shall have one for futures. You can of course, as we did in our initial discussion, you can trade futures on the Nairobi Securities Exchange, but we still don't have a digital platform for that. Thank you so much, Chris Njero. Do you have one on your end?
Yes, I have Kiragori Martin, who is asking, what about NCBA? Is its valuation okay? Now, Kiragori, because of conflict of interest, I cannot be able to comment on the valuation of NCBA because NCBA Investment Bank is a subsidiary of NCBA Group. So for that reason, I cannot be able to comment on whether it's fairly valued or not. Then I have Janet Wanyi, who is asking, what about treasury bonds? We may be able to come up with a webinar talking about fixed income as an asset class. And we may be able to look at valuation of treasury bonds and how investors can be able to get into them. Yeah, we may be able to look into that, Janet, and we'll discuss and see how we are able to come up with a discussion on the same.
All right. Thank you so much, Dennis. Remy Tonui. Remy Tonui is asking which stocks and companies that one can invest in and how much can one invest? Thank you so much, Remy. You can invest in companies, well, in general is in two ways. The two ways you can, two or three ways. You can invest, of course, in your own company, which is privately. Then there's those ones which you can invest on what we call private equity, which means they are companies which issue their shares, but at a private level. We deal with those shares that are listed, which is the other way of investing in companies, and those are the companies whose shares are listed on the Nairobi Securities Exchange. So we can assist you, and we are here as a broker to assist you to trade in any share that is listed on the Nairobi Securities Exchange. The minimum number of shares one can actually invest in on the Nairobi Securities Exchange is 100 shares in any counter. So that means that there are counters at different price ranges, and all you need to do is look at their price and see how much 100 of those shares costs, and that is the minimum that you can actually come in and invest.
Sure, this one,
okay, go on, Dennis. Sorry.
This one is, I think you as Jane Mumbi is asking, can one hold shares with different stock brokers?
Yes, Jane, competition is a very good thing, and it is true that we have several brokers in our market. you can actually have a share and CDSC account listed with different stockbrokers. Note that the CDSC account itself does not change as long as it is registered at CDSC using the same ID. So for example, if you used your ID to open a CDSC account at NCBA Investment Bank Brokerage, and you use the same ID to open a CDSC account at another brokerage, what will happen is that that CDSC number will not change, will be the same CDSC number being held at different brokerages. However, what happens is that if you buy shares with NCBA Investment Bank and they go to that CDSC account, and you go to the other broker and buy, maybe, let's assume what you bought at NCBA Investment Bank or Safaricom, and at the other stockbroker you buy, say, NCBA shares. Now what is going to happen is when you come to NCBA Investment Bank, the only shares we will be able to see and you will be able to see on the statement from us will be the Safaricom which you bought through us. In order to see the NCBA or even to trade them, you will need to go to the other broker. And that of course applies for if you bought Safaricom on both ends. On each end you will only see the ones you bought from there, and you can only sell the ones you bought from that particular broker with that particular broker. There is also a way of transferring shares from one broker to the other. So if you feel you want all your shares under one brokerage, you can approach the broker who you want to leave, to move from, and they will give you what we call a transfer form. The actual form is CDSC 4A 4B form. And that form is what you bring to the broker where you want to move in order for them to submit to CDSC for your shares to be transferred now to the broker who you want to use consistently. If you want to see your entire list of shares, assuming you have brokerage accounts with 6 or 3 or 2 brokers, you need now to request your statement directly from CDSC. The CDSC statement will indicate the number of shares you hold with each broker, and that is how you, the only time you can be able to see the entire portfolio of shares that you hold. Thank you for that one. I think I've also addressed what Njeri Shego was asking. How can I transfer my CDS account from another broker to NCBA? And I hope, Njeri Shego, you are coming, you have decided to move it to NCBA. Then we have another question. What stocks do you recommend as a strong sell at this time? Wow. I will let Dennis handle that, but before I let Dennis handle that, from a business development perspective, when you are looking at your portfolio, it is very individual, it is very individualized, it is very, and as Dennis mentioned, your risk profile, your portfolio has a lot to do with your individual stock holdings. So a lot of recommendations we make cannot be generic for everybody, and therefore, based on what your portfolio is, my advice, which is from a business development perspective, before Dennis tells us from a research perspective, is that you look at those stocks which you hold, which are what we call value traps. Now, a value trap is those shares that you buy and they do not increase in value, the companies are not performing very well, they probably dropped by a very big percentage, but when the research side looks at, you look at the research side or the fundamental side of that company, there is no fundamental indication of an improvement of the situation, which means that that is money lying somewhere that is not likely to make you a good return. Maybe they don't even pay dividends. And it would be a good idea to get rid of such stocks in favor of what we call growth and defensive stocks, which give you a good dividend and also give you a better chance of gaining, of capital gains, which is the share price gaining. So you can leave a company with bad fundamentals to go into a company with good fundamentals. And that would be my advice in terms of how to deal with your portfolio. Can I hand over to Dennis, because he would be more informed in terms of what he would recommend as a company which is a seller at this point in time.
I would say, Gishwai, you have done quite well in explaining that. And I would just build on that. It quite depends on what you're holding on your portfolio. It cannot, a sell recommendation maybe not be a blanket recommendation to everyone in the market. But I would say a sell recommendation without quoting any names would be a company that has some structural challenges, a company that is maybe suspended for now or undergoing liquidation. When that company resumes trading, then maybe that is a company that you should be selling. But I will not be able to come up with names of stocks that you should be selling at this point.
Thank you so much, Dennis. I would like to look at one other question here, which is quite interesting. This is Wayne Njoe. This of course, is in relation. He says, I am using NCBA app and would like advice on how to trade on the platform. Wayne, kindly share your contacts with us. We did discuss the online share trading platform, which is just replicated on the app, which means that once you can use the online trading platform, the mobile app is just the same platform which is optimized for the mobile phone. So what we can do is we shall share with you what we did last week on using the online trading platform, and based on that, it will be very easy for you to navigate the online platform. Another ambitious question from Kimani Wamaura. Kimani Wamaura, another ambitious question. Can someone pay his loan to NCBA with shares in stock exchange? E.g., I have shares worth 2 million and a loan worth 2 million. Unfortunately, I have not seen this kind of transaction done before, and I don't think that is a possibility. However, the easier or the most simple way to do that would be to sell the 2 million worth of shares and pay the loan to the bank. But you can actually take a loan on your shares. Now, that means you can have your shares used as collateral for a loan. I believe different banks will offer you a different percentage. With NCBA, I believe it should be about 50% of the value of your shares. And what you do is you can approach us and we can help you to pledge those shares as collateral through our credit department. And what will happen is that your shares will be frozen and you cannot trade them until you have completed paying the loan. Once you complete paying the loan, again you approach us and we will be able to unfreeze those shares and you can be able to trade them. Thank you so much. Back to you, Dennis.
Yes, I have a question from Emmanuel Chumba, who is asking, how can small businesses transition into companies and allow people to invest into? Now, Chumba, what you're asking is how can a company be able to list on the Nairobi Securities Exchange and allow the public to buy shares into the company? And I would say right now, the NSE is running an incubation hub that is educating small business owners or SME owners on how to transition their companies into public companies. And that would be a great platform to look into and see how the NSE can be able to help you into that. But yes, scaling up and allowing the public to invest into would be a great avenue for your small business. But I would advise you looking towards that incubation hub that the NSC is currently running with. Then I have Jack Yongo, who is asking, how do you value Stanley Braid stocks? The Stanley I-rate, as we highlighted earlier, a rate is an investment that is basically looking into real estate, and it's an income generation business from real estate investment. So the easiest way to be able to value a rate stock is to, first of all, come with the bottom-down approach, understanding how the real estate market is doing and understand how the company generates its revenue. Once you're able to see how the cash flows are coming in for the Stanley Fahari I-rate, you're able to see whether you can be able to recoup because the I-rate is required to distribute about 80% of the income. So if they're able to generate increasing income over the years, then that would be a good valuation for you. But if you're seeing the real estate not doing so well, then that will impact the income that will be able to distribute to you over the years. And that now changes how you value the I-rate. That would be the basic methodology. Then I have Moses Kamau, who is asking, is Centum a good short-term investment? It depends, Moses, on how you're looking at it. Do you see a value trap, as Gishohi was saying? Can the stock go up in the next 1 month, or what will happen? You can speculate. It depends on whether you're speculating or you're a fundamental investor who is looking at a long-term horizon of about 3 to 5 years. And I would say fundamentally, Centum is a company that you would want to buy, not for short-term purposes, but for a long-term purpose, given their business model. So you can do short-term for speculation, but fundamental-wise, it's a long-term investment. Ishohi?
Thank you so much. Very informative. Thank you, Dennis. I am looking at a question from El Mariach. How can one withdraw from your CDS to M-Pesa? On the online platform, we have a place where you can tick for payment. I think we saw that on last week's presentation. Once you click there, please just note your phone number there, and we can be able to use that to pay you to the CDS account to your M-Pesa. Now note that that number that you give us there has to be the number that you registered with us when you registered the account. Of course, alternatively, if you're not on the online platform, you can send us an email, provided your email is indemnified, and you can send us an email and tell us to pay whatever money you want to your M-Pesa account, and the phone number. Again, make sure it is the number that we have registered on our end. There's another question there from Edel Karau. Edel Karau, would you recommend opening a CDSC account with a broker or directly with Central Bank? The pros and the cons. Now, the accounts you have mentioned are actually two different accounts. The CDSC account, which stands for Central Depository and Settlement Corporation, holds shares and corporate bonds. The CDS account at Central Bank of Kenya holds government bonds. Therefore, when you want to trade in shares and corporate bonds, which are shares which are issued by companies, private companies, of course, the CDSC account, the account that you need is the CDSC, which you have to open with a broker, and CDSC is actually a corporation itself, which deals with the settlement and the registration of the shares so that you can be able to trade on the electronic platforms. Now, CDS at Central Bank account, you cannot open through a broker. You actually have to present yourself to CBK and do the opening of the CDS account, after which you can now approach us as a broker and register us as the one who can trade on that CDS account. And now from there on, you can be giving us your bond deals. You can use us to do the purchasing and the selling of bonds on your behalf. So these two accounts are different, and I wouldn't say there's a pro or a con, because for the CDSC account, you do have to open it through a broker. You cannot open it without a broker. And for the CBK account, you have to go to CBK. You cannot open it with the broker. So at the end of the day, this is just something that has to be done in a certain way. Thank you so much, Edel Karau, for your question, and I hope that it has been useful. I will just take one more last one before I hand over to you, Dennis, for some other questions. And this is from Jakadwal. Jakadwal is asking, can I open a CDS account online? Currently, no. Reason being, there are certain requirements in terms of KYC, which is know your client, and documentation that is needed at the onset. But once you have opened the CDSC account, you can then now be offered all the online platforms which you will be able to use for all your investment purposes without ever needing to do paperwork again. Thank you. Can I hand over back to Dennis so that you can be able to
the question Sam, the question I'm seeing from Susan, it's in your docket, I believe.
Susan Mwangi.
Yes.
I have a CDS account with another company. Can I transfer the shares to you? Again, I think we had already discussed this, and I will go again and discuss it and explain how it works. when you have a CDSC account with a broker and you want to move to a new broker, what you would need, Susan, and you can share your details with us, is you give us, we will send you our account opening forms, or you can visit any NCBA group branch and they will assist you to open a CDSC account with NCBA Investment Bank. Once that account is open, you will need to approach your current broker, the one you're moving from, and you will need to request them for what we call a CDS4 form. It is called a transfer form. They will give you the transfer form, and once you get the transfer form, you will submit it or will hand it to us at NCBA Investment Bank, and we shall do now the submission to CDSC, and within roughly 1 week, your shares will now be transferred from the other broker to NCBA Bank, and you can be able to trade through us. Please note that while you're waiting for the transfer to happen, your account is active, and so you can still trade. It does not affect your trading activity. Thank you so much for that question, Susan. Dennis?
Joroke Kihuha is asking, how much overhead costs does one incur when selling shares?
Joroge Kihuha, thank you so much for your question. It is an important question. We have what we call a matrix in how the commissions are charged, because the transaction cost in buying and selling shares is the commissions, which are paid both for the broker, and there are some statutory charges, which include, for example, those that will go to our regulators, CMA, NSC, the market, and also there's a certain charge component of that whole charge which goes to the investor compensation fund, which is a fund that acts as a sort of insurance to investors in the event of, say, companies going into liquidation. There is not going into liquidation, or where there is an issue with the brokerage. And now, the charges are actually standardized across the board, and the commission charge for any transactions below 100,000 is 2.1% of the amount. So this is when you buy, you will be charged that when you sell. So you have to be careful, because as you do your calculations, you have to make sure you factor in what you will be charged for as a transaction fee. Anything between 100,000 and a million will be charged 1.84%, and then anything below anything above a million, and that's a block of 1 million shillings, will be charged 1.54%. Any other charges that come with the trading would need to be something you communicate with your broker and ask if they have any further charges. But as NCBA Group, we do not charge outside of that. Of course, there are those other charges that will come with things like updating and even getting the research from Dennis. There is a small charge of, say, 100 shillings, which will happen on your account in a month when you trade, but it is not a standing charge. So if you don't trade within a month, it does not get charged, and that charge is regardless of how much you traded within that month. You will not a 100 shilling charge on your account. That is all the charges that we have, apart from, say, if you are reactivating accounts, and that, which are separate charges. Thank you so much for that question. We have another account asking from Bonnie Mbote. Bonnie Mbote is asking, how do I check my CDSC status online? I think the only way to get your CDSC status is usually from an email, which they usually will send an email to you. We can also assist you with your CDSC status if you have an account with NCBA Investment Bank. So you can engage us, and we'll be able to look on the CDSC platform, which we have access to be able to check what is your status at CDSC. The only other way is, of course, to communicate directly to CDSC and find out what is your status. CDSC is located at the Nation Center on 10th floor. So if you want to visit them, make sure you carry your ID with you so that they can be able to help you to access your account and your statement. However, CDSC does send periodic statements to your email, and if you do get that email, if you reply on that email and request your status, I am sure they will be able to assist you. Dennis, is there anything else on your end?
Not really from my end. No further questions for now.
George Gashanja. George Gashanja is asking, I used to trade using your online platform. Now when I now when trying to log in, I usually get user suspended. Why is that? And when reaching out for help, you people go silent on me. Okay, George, I will share my email with you. My email is Samuel, SAMUEL .Gishohi, GICHOHI @ncbagroup.com. Now, all I need is your either your CDSC account number or your ID number within the email, so that I can be able to sort out your suspension. Just send it to me and I'm going to sort that out. Now, the reason an account goes into suspension is if you key in your password 3 times and it does not work, then that will usually suspend your account. And once that happens, whenever you see the account indicated suspended, send us an email requesting it to be unsuspended, and always ensure that you give us either the username of that on your online platform, your ID number, or your CDSC account number, or your client code. Any of those will help us to locate the account and be able to reactivate the account. George, I'm sorry if you sent an email of that like that and was not responded to, and I'll make sure that that is done. Thank you for your question, George. How long, Sam Omondi, for how long can a CDSC account remain dormant? Thank you for your question. The dormancy at CDSC happens usually if your account has been inactive and there's no trading has happened on your account for 2 years. However, once the account has become dormant, the only thing that stops you from doing is trading. You cannot trade on that account unless you reactivate it through your broker. However, if you are not intending to trade at any point in time and the account remains dormant, the shares will sit in that account, and they will just sit in that account. You will still get your dividends. You will still be the beneficial owner of those shares, but you cannot access those shares to sell unless you reactivate that account. So you'll notice that when you go to your broker and your account is dormant at CDSC, meaning you haven't traded for over 2 years, then what will happen is there are some forms you'll have to fill in order for that account to be reactivated, and then you can trade and it will be active for another 2 years. And if you don't trade again for 2 years, then that dormancy will recur. Eunice Chepchirchir. Can my trustee open the CDS account for me while I am abroad? Eunice, I think when you're abroad, the most convenient way to open an account is to open it using, you fill our forms, which we can send you an email. Then you have the forms notarized, sign them and notarize them. And then you can send us the scans of those notarized forms and we can proceed to open the account. But you need to also mail us those original signed forms, which we can receive at a later date, but we can begin to open the account as long as the documents that you're sending us from abroad are notarized. I have, do we have any other questions on your end, Dennis?
Maybe I'll take the final one, and it's from various people who are asking whether these video and presentation will be available for later. And yes, the video will be available on our pages on Facebook and also on YouTube. So yes, you can be able to access it later and review the material. Sam?
Yes, there was a question earlier. Where was that? You actually mentioned something about it, how a company can transition. Yes, Emmanuel Chumba, I would like maybe to add a little bit to that. How can small businesses transition into companies and allow people to invest into? Part of our offering at NCBA Investment Bank is what we call advisory. And such questions, depending on the size of your company, would be best addressed to our advisory unit. and they would look at your valuation and the kind of business you do, and they would be able to advise you on whether the best way to go would be probably a private placement, which means you look for a number of shares of shareholders, and they can help you to do that by creating the necessary documents and the necessary approvals that you may need for your company in order for you to be able to reach out to private equity investors or private investors to be able to invest in shares in your company, even without listing. Also, they are the same, and they're the same unit of our investment banking business who will be able to advise you in the event your company has reached that size when you want to list on the Nairobi Securities Exchange. And when you're listing on the Nairobi Securities Exchange, of course, you have options like going on what we call the GEMS market, the Growth Enterprise Market segment. And the Growth Enterprise Market segment is specifically designed for growing enterprises, as you can hear from its name, smaller companies that are coming up. And what will happen is when you're going on that market, you will be assigned a nominated advisor, which is something we also do at NCBA Investment Bank, who will be advising you and taking you through all the steps of how to manage your company as a listed company as it grows, so that eventually it can now go onto the main boards of the Nairobi Securities Exchange. Thank you so much. Dennis, is there something else?
No. For now, we have come to the end of our today's webinar, and we are grateful to our viewers for joining us this morning, and we hope it has been grateful information to you, and we continue on this journey. These webinars are useful for your investment journey, so we are hoping you are going to continue moving with us as we move even into the next webinar, and we'll be able to invite you when we plan on that. So for now, we are grateful for joining us this morning, and I wish all of you a very, very great day and a great weekend ahead. Bye-bye.
Bye-bye.